A very warm welcome to you. Many thanks for being with us on this week's edition of the program. We remain your source for all the latest happenings in the world of business. My name is Lucy Iambi. You are welcome. On this edition of the program, we'll bring you excerpts from the interview with Mr. Eddie EFEKOHA, Managing Director, Consolidated Hallmark Insurance PLC, on the CEO Rendezvous, where he spoke on the future of the Nigerian insurance industry, effecting changes for growth. Speaking in the course of the interview, Mr. EFEKOHA noted that risk-based capital is still the best option for the Nigerian insurance market. Take a listen.
One of the things that we identified was the issue of recapitalization. So when you talk to me today and ask, what are the things? I would say that, yes, the industry indeed needs to be well and better capitalized, okay? But in the next 10 years, is it just capital? And is it capital the way it's being done now? I think if you ask me personal view, I would have thought that some little tweaks would have been necessary. I wouldn't have gone for the quantum of capital because it needs to be related to the market and to the business. And rightly so, just before all of this fixed amount capital, we were already talking about risk-based capital, which meant that you needed capital that spoke to the level of business you're doing.
On this edition also, we will bring you highlights from the 7th Annual Business Today Conference that was held recently at the Oriental Hotel under the theme, Consumer Satisfaction in Deepening Penetration in Insurance and Pension Sectors. Keynote speaker was Dr. Muda Yusuf, the Chief Executive Officer, Center for the Promotion of Private Enterprise. As always, it was a platform for exchange of ideas. Let's check out excerpts.
The consumer is the vehicle through which insurance and pension sectors will achieve their target on penetration and market deepening in pursuit of the country's financial inclusion reports. Therefore, satisfying the consumer, or what today has been rechristened as consumer experience, is critical in achieving these goals.
When you're talking about having accurate data, you are having a different figure. You know what you are doing in the state, but you are under-reporting it. How will you want to even be rated as a company and as an industry?
These and more are what we have for your viewing pleasure this week. So sit back, relax, and enjoy it. Details in just a moment. Please stay with us.
Next 10 years. I've had the privilege of serving in two arms here and there, the NIA before the CIN. And one thing I recall that we did at the NIA, even with the current commissioner then as a DG, was to get some of us leaders in the market, 12 of us then, working with KPMG to produce a roadmap for the industry. That for me was a star achievement during my tenure at the NIA. Because if you have not planned for your future, what you have done indirectly, you have planned to fail. So certainly you will fail. But if you know that this is the way I will need to go, and we all jointly say, yes, this is the way truly we should go, having weighed all the options available, then surely, slow and steady, you will get there. So we did. And one of the things that we identified was the issue of recapitalization. So when you talk to me today and ask, what are the things, I would say that, yes, the industry indeed needs to be well and better capitalized, okay? But in the next 10 years, is it just capital? And is it capital the way it's being done now? I think if you ask me personal view, I would have thought that some little tweaks would have been necessary. I wouldn't have gone for the quantum of capital because it needs to be related to the market and to the business. And rightly so, just before all of this fixed amount capital, we were already talking about risk-based capital, which meant that you needed capital that spoke to the level of business you're doing. If you are doing motor, and motor constitutes 80–90% of your business or portfolio, then the capital should not be the same as someone who is doing any of the special risk. That for me is a concept of risk-based capital. But today, our regulator has moved from there, even though they started it, but they moved from it and went the absolute number without taking account of the volume and the profile of the risk you have underwritten. So during my time at NIA, we did this project having that the capital we thought we're looking at was one that was based on the risk that you are running. And of course, rightly so too, I think there are some other minor issues. They may appear minor, but they are equally key, which I know the leadership of the industry have tried to engage the regulator. And I think that is important for us to focus at the entire stakeholders. Everybody matters in this equation for this industry to grow. You need to reward employees very well, yes, for them to give out their best in delighting the customer. The regulator needs to do what they have to do, and they need to get their levy and all of those things, yes. But this group, when we talk recapitalization, we are speaking to investors. And this group of stakeholders must equally be delighted. How are we delighting them? How are we delighting them? And that is why I think that we've been talking about the Insurance Act review for some time. It's taking time. We all. So in the next 10 years, I'd like to see that matter driven speedily, because there are a couple of issues in the current act that are anti-investment. When that act was contemplated and put in place, appraising unexpired risks was by rule of thumb. I remember my growing up days, some of the companies, when they come to the end of the year, what they do is that this risk are all still running. They just allocate 10,000, 5,000 to each of them, not minding the, in quote, the quantum of risk we are talking about. During that era, therefore, if you say there is need for a contingency reserve, it's understandable, which is like a second level protection for the customer. Then nobody talked about IFRS. Today, we are talking of IFRS. Today, we are talking about actuarial determination of the value of unexpired risk. So, if these calculations are truly actuarially determined and supposed to be correct, then there should be no need for contingency reserve, because now you are computing the risk. Nobody is just dropping numbers. And that is why I'm not blaming anybody. It was nice that we had the Insurance Act at the time we had. But today, knowing what we know, that act requires review. Because the contingency reserve, whether it's stated otherwise in the current act, is taken out of profit. And that is why the investors are not getting enough. And investors will not come to this market until the returns come to them. They put money and then you are setting the money apart. After you have taken profit, you've taken everything, taken tax, and then what is left, you now say part of it goes to contingency and part. And even to make matters worse at a time of recapitalization, you say you are not taking account of it. When will these investors take account of the money you are keeping for them under that contingency reserve? Is it only when the company truly fails? Because it's only when you will now liquidate the companies that money will be available. So these some challenges, which I think in the next 10 years, there's need to resolve them. If resolving them means that we need to review the act, sit down and review it in line with what, let's do so. Because it does not speak to international best practice, in my own opinion, at the moment. We need to look at it. It's only, I think, those living in the century or the generation to begin to define capital as paid up and not shareholders' fund. I don't know. I know that there's one word called shareholders' fund. So in financial parlance. So what does that mean? Meaning that the money making up that belongs to shareholders. So when you are now going to take money, you still want more money from shareholders. Why is that definition not changed? I think these are issues so that investors will come and know that investors are locked in. And those who are already in, they're already in. They can't get out. But if they have the window, they will get out. The issue is that we need to address these issues. That's another aspect I like to see. Of course, insurance industry, we need to woo the young ones. Because indeed, times where we thought that insurance is insurance, you need to just study insurance in order to. No, insurance is for all segments of life, all facets of life, meaning that we must have that knowledge. So we must attract the young one from all the disciplines into our industry. And also, I will take one point again from the 10-year kind of roadmap we did at the NIA. We recognize the population of this country and realize that there's no way we can get there, particularly to the bottom of the pyramid, without evolving agency and using technology. And we realized that we needed to give a boost to the agency, which will help to absorb a lot of the boys and girls who have graduated and have no job. But of course, you all know, insecurity have not helped. This agency is concentrated in the mega cities, Lagos, Port Harcourt, Abuja. Of course, it could have been elsewhere. And today, there's need for a lot of partnership with so many sectors. COVID-19 has told us the only way to live is technology, is digitalization. How can we do all of this when our industry cannot partner with the telecom and in a manner that the regulator and all of that will say sign off? I think we need to. So I like to see an industry that truly appreciates the values that will be derived from partnering with other segments and sectors of this economy. We need to bring this. Insurance cannot exist solo because we will not derive the right returns. We need to now to really, really engage others, and together we will be better. Together, again, I think professionals who are working or the staff working in the industry will be okay. Government will be okay because the tax and all of that will improve. You know, I don't want to get into that, but you know that one of the commonest issues that we discuss when we gather is penetration. How much are we generating by what premium side relative to market and all of those things. So if we are not driving more premium because of the partnerships we're not going into, what happens? Levies to regulator will increase. Tax to government will equally increase. And there will be surplus to pay our people fairly okay, better than it is today. You still find today CEOs who have retired in this market living like paupers. Why is it so? It shouldn't be. Or, if, let's say not CEO, but senior members of staff. Because they have not been adequately remunerated. So we need to, I like to see some of these little snippets here and there addressed in the next 10 years so that this industry truly will look back and we are happy that, yes, we came here, we passed through, we made these suggestions, and we are happy that they are in place. Thank you.
The second thing I'd like you to consider and debate is the role of the telecoms industry in facilitating the growth of mobile payments. We must come up with a win-win solution that enables the banking industry, the telecoms industry, to work side by side to grow a successful mobile payment industry that is the envy of other nations. And the third and final thing I want to ask you to think about over the next few days is e-commerce. A mobile payment system is useful when there are things to buy. And right now, our e-commerce system industry is one of the fastest growing in the world. We're looking at an industry that will be about a $10 billion industry within the next 2 to 3 years. However, even at $10 billion, we're just scratching the surface. And what is really going to drive this industry is the capacity for the low-income Nigerians to make payments on this infrastructure at little or no cost.
All right, welcome back. Moving on, we now bring you highlights from the 7th Business Today conference organized by Business Today Communication Limited. The high point of the conference this year was the question and answer session. Happy viewing.
The annual Business Today conference is a platform that brings stakeholders from the pension and insurance industry together to deliberate and find solutions to issues that affect the operations in Nigeria. The 7th edition with the theme Consumer Satisfaction in Deepening Penetration in Insurance and Pension Sectors was held recently at the Oriental Hotel, Lagos. Keynote speaker was Dr. Muda Yusuf. Welcoming participants to the conference, the Managing Director of Business Today Communication, Mrs. Nkechi Naiche Esezobo, noted that the consumer is key to deepening insurance and pension sectors, given the large number of people in the informal sector.
The consumer is the vehicle through which insurance and pension sectors who achieve their target on penetration and market deepening in pursuit of the country's financial inclusion report. Therefore, satisfying the consumer, or what today has been rechristened as consumer experience, is critical in achieving these goals. While the insurance industry have the task of increasing its penetration above less than 1% benchmark that have existed over the years, the pension industry as well have the task of increasing contributive pension enrollment to capture the large population of Nigeria in the informal sector. Whether we like it or not, the informal sector is getting bigger every day. And the only way we can achieve it is to come out with products that can actually help to bring these people into the kitty of deepening penetration. The outcome of today's conference is expected to create the necessary environment and strategies that will drive penetration, particularly in the informal sector of both sectors.
Delivering the theme of the conference, the keynote speaker, Dr. Muda Yusuf, noted that both the insurance and pension sectors must strive to exceed customer expectations at all times.
Customer satisfaction is equal to performance minus expectations. If performance is greater than expectation, that means you have surpassed expectation. That is very positive. If performance is less than expectation, that is negative, isn't it? When you have a negative outcome, that is not good for the business. It's not good for customer. So performance and expectations are very, very key, for us to be able to meet the satisfaction that we set out to meet. Next slide. Customer expectation from PFAs. Well, some of the things that at least we were able to gather in terms of what customers or clients expect from pension companies, being online real time, so that whatever information anybody needs can get quickly. Minimum bureaucracy, because some systems are very bureaucratic. You don't want to be going from table to table. And in fact, people like to do things digitally. There is no time to waste. Delivery of services as promised, this is about expectation. If you promise X, be sure you deliver X, or you surpass even the promise. Quality of clients' records, good disposition. Next slide. Technology-driven service delivery, ambience of office facility, as a sense in which the environment of the office also inspires confidence. Because if you are keeping people's assets, money, and they visit your premises and it's looking as if you are struggling, it can send a wrong signal that, my money may not be safe there. These people that are looking as if they are not,
Panelists at the conference this year were Mrs. Ido Okwasa Okeahelam, Mr. Olasupo Shugilola, Mr. Demayowa Adeduro, and a host of others. The high point was a question and answer session.
Now, when you're talking about having accurate data, you are having a different figure. You know what you are doing in the state, but you are reporting it. How will you want to even be rated as a company and as an industry? I have seen a company that tells me, before this adjustment in rates, I was getting about 600 million premium from one company as a co-insurer, not a lead insurer or a sole insurer. Perhaps because of this adjustment, I'm looking at 1.something billion. Then you go back to the books of that company to actually see if that 600 million he was collecting from that company is reflected in his books. And you don't find it. And we're talking about data. And we're talking about NICOM as the regulator should have the data of the. So when they say your penetration is less than 1%, who is responsible for that penetration that is less than 1%? Because we know that if you have all the accurate statistics, that penetration level should be higher.
NICOM in the past was doing very well, but up to a large extent, they now want to follow the banking industry trajectory, taking over assets, taking over to run that business, and maybe sliding some of the penalties. That's what we are today, that most companies are not doing well. You told us that when you have gone round and somebody in their value, their books, have not even reflected what they are passing to you, but you are the one who approves those accounts. If you are not approving those accounts and issue a penalty for them to pay fine, that you are making 600 million, it's not reflected in your books, and they come to you and you approve the same account, why would they not shortchange? Because you approve the account. How much have been paid to regulators to approve such accounts?
In line with its objectives, the conference again met up to its billing of providing a platform for serious conversations on a growth path for both the insurance and pension sectors.
That's our time on the program this week. Many thanks for being with us. Join us again, same time, same station next week for a fresh package. But in the meantime, feel free as always to connect with us on all our social media platforms. Join us every Wednesday by 9:45 a.m. on our flagship radio program, Waiting Insurance They Do Safe on Niger FM 102.7. My name is Lucy Yambi. Until next time, from the entire team, bye-bye.